Duncan, you know all about this.
Yeah,
Duncan just turned his hat around like Sylvester Stallone and over the top.
Wait, are they gonna find this? What do you think? What's your take?
I mean, I heard someone saying that sounded reasonable, that they think that he was throwing people off the trail, that he's not really in that park, but he went somewhere else, but parked his car there to make people think that's the last place he was.
I think he's in the metaverse, like Lawnmower Man.
Possible.
Wait,
He's an NFT.
I think they'll find him.
This is the new, who is the white Bronco guy?
OJ?
This is
OJ.
the new, like,
Did you
watching
just say who was the white Bronco? All right, Josh, no more pop culture topics for Dan.
Pop culture, it's a murder.
Who is the white Bronco guy? All right, let's talk.
He's not even. Yeah.
Let's talk investing. Let's talk investing.
All right. I want to start with this. Why is Peter Mallouk tweeting about target date funds at 8 o'clock in the morning? And why are you arguing with him?
I wasn't. First of all, I love
Get these tweets on. I know you like him.
I love Peter.
It's not personal.
No, it's not at all. I love. No, actually, I like literally never, ever.
Hold on. Look how John formatted these tweets. You are a gem, sir.
I never. One of my superpowers is like not giving a shit about people's opinions. Maybe that sounds really dickish. I don't mean it that way, but I generally don't care about. If I disagree.
Wait, stop. Could you imagine he tweeted that? One of
No,
my
I know.
superpowers.
I heard it. It sounds ridiculous coming out of my face. But my point is, when I see an opinion I disagree with, I don't get triggered.
Except in this case.
I'm not triggered at all. I'm genuinely curious.
This is a CFP, right?
Probably.
I thought
Peter Mallouk he owns Creative Planning. It's one of the biggest RIAs in the country.
Yes, he's a registered advisor. He still works.
Okay,
for
so
us.
he's not just some.
He's legit.
I have deep respect for him. So I was genuinely curious why he said that.
I just read his tweet.
Go ahead.
Okay. Target date funds are popular investment vehicles in 401k plans. That's what we call in the business the setup. That's unfortunate because they're a terrible choice for most people. That's the turn. Don't choose funds tied to your age unless there are limited options. Instead, choose a portfolio or a few funds aligned with your goals. And Batnick's like, okay, but why?
No, because I genuinely wanted to hear his opinion. So
yes, fair enough.
Somebody had a great reply talking about if you're depending on your risk tolerance and all that. And my whole point was, I understand a professional trying to recommend something better than a TDF.
Yep.
But what Peter said was, like for most people, they're a terrible choice. And my point is, if you're not a financial professional, and maybe even if you are, they're a fantastic choice. What else are you supposed to do?
If he would have said suboptimal instead of terrible,
Exactly.
Right.
there would be no conversation.
That's why I had.
That's what Twitter does,
Yes.
though.
So Peter said, with 15 minutes to an hour of education, they could do better. And I actually thought this was really interesting. Somebody said an hour of education would lead to materially worse returns for someone with no investment knowledge. And I thought that was
Why are you nodding to that?
that nailed it. So explain, Dan.
The curse of like what is it? It's like
Knowing a little.
climbing Mount Stupid.
Yeah.
Yeah. You know, like it's that constant thing of like you don't know how much you don't know. And I have a friend.
What's Mount Stupid? So you get a little bit up and you think you're at the top?
Yeah, exactly.
Okay, got
and
it.
then you like crash down the other side. And
Okay.
you like you start up by saying you know you don't know, then you learn a little bit and you're like, no, I know stuff now. And then like you're really wise when you're like, I know how much I don't actually know about this anymore.
Right.
So I think that's true because I have a good friend and wonderful person, dumpster fire financially.
Yeah.
And got involved in Robinhood and like
Is that John Stein?
He didn't get the whole like T+T2 clearing time type thing and like
Right.
ended up getting overdrafted from his bank account, right? And so it was this whole like, it wasn't strictly speaking like he chose bad stocks or whatever. He just got into a system that he didn't understand, but he thought he did.
Okay.
He thought he was comfortable and confident trading inside of it.
Right.
And he got like, he messed himself up.
of course.
So I think that's absolutely right, that it's very easy to spend a little bit of time in finance and get comfortable with terms and jargon and what you do and how the app works and think that you're good to go. Because like that's true of a lot of stuff. Facebook, Twitter, et cetera. But like the potential for downside, the stuff you don't understand, it's different. There were so many things in that. It was like, you know, number one, most people don't choose target date funds, right? I think it's like 80% of people get defaulted
to that.
Right.
Well, he's saying that.
Yeah.
He's saying it's a terrible choice that you're being defaulted to.
There's like, if you're defaulting somebody, the only information you have about them is usually like their age.
So here's what Peter's saying, and I do agree with this. If you are in, and the Vanguard target date funds, I mean, they're dirt cheap. They're a couple of basis points. The 2040 funds, so that's assuming, I guess, that you're going to be retiring in 20 years from now. So call it you're 40 years old. They're recommending 20% bonds. And I think it's a fair criticism that if somebody's going to be retiring, not dying in 20 years, right, they still have ostensibly another 50 years of their life left, why do they need to own 20% of their portfolio in bonds at a yield of 1.3%? And I think that's a fair criticism. But I still think they're a
nobody
better
would be
option.
saying that though if the stock market wasn't up 12% a year over the last 10 years. Like,
and yields weren't like
nobody would be saying
1.5.
why do they need to own 20% in bonds? Think about how insane that statement would have been. Like even if you made it 10 years ago, why would I own 20% in bonds? What are you saying? I should be 100% stocks? Like a lot of this is the context of the world that we just are in.
100%.
I do think it is correct, but I think this is a great, like, perfect is the enemy of the good, right? Like, the thing that jumped out to me is, all right, so target date fund is just a single fund. And if you actually have a traditional and a Roth 401k and a traditional and a Roth IRA and your spouse's account, you can do some pretty slick stuff with like asset tax location. The stuff that we did on it, this was impressive to me. It was like you end up with 30% more spendable money in retirement if you do that by putting different asset classes in different accounts. You know, like the Roth is tax-free.
When bonds used to have a yield.
Yeah, it's like, so the same asset, like no opinion about what the right asset allocation is, but where you hold them, if you can split it up and do smart stuff with it, you end up with more money. So I think that, but that's optimization, right? That's like level 10 wizardry of like, I'm going to do some pretty impressive stuff, and you'll end up with more money in 30 years when you're taking money out of the traditionals, the RMDs, et cetera. But like, yeah, like, am I going to say don't invest in a target date fund until you understand asset tax location?
Yeah,
absolutely not.
You should. The expectation should not be that most people are going to even if they spent that hour educating themselves. Okay, where do they begin?
Right. They're not. Yeah, exactly. So TDFs.
Can you imagine where they're going to educate themselves on Market Watch?
They're at least 95%
seeking alpha.
They're at least 95% towards perfect, in my opinion.
Yeah.
Like
so, all right. So this is the money quote. We can end it, but he's saying pick a not. This is somebody replying to you guys, to you and Peter. Okay. Quote: pick a target date fund and max your 401k contributions and leave it alone. Is the highest EV advice for 99% of people in the workforce. It's the highest electric vehicle advice? What is he saying?
It's good. What does
EV mean in that context? We don't know.
Expected value.
Expected value.
I just want to end this with a quote from Peter and let him go out on good terms with this one.
Oh, no, you're done.
No. Hang on.
Grantham, Maluk. Who else you want to with this week?
He said, okay. Peter said, the advice here is simply to do what is likely to create the best outcome. He said, 401k investing is better than not investing. Start now is better than waiting. Low cost is better than high cost. Risk-based model is better than target date fund. Okay, whatever. We could quibble with that. But by and large, we agree. We mostly agree.
Well, we agree on all the important aspects of that. Right. And nobody should 100% agree on everything with everyone.
I agree.
So,
I agree.
Yeah. You agree with that?
I agree with
that. I
don't
agree, but yeah.
You disagree? Good. Yeah. So that's how it should be. Delta is fading away. Maybe not forever, but cases are down significantly. All over America. In Europe, cases started falling precipitously 2 months ago. The predictions were right. It faded there. It's fading here. Hopefully there's not like a new creative way to kill us on the way, right? So everywhere that happens, what we're seeing is a ramp back up in the economy, which actually may not be a great thing because I think it's inhibiting the Fed's ability to do what it wants to do. The inflation data.
No, it is a great thing. You mean it might not be a great thing for the stock market?
Not great for the fact that the economy is ripping right back up in these places is making it harder, not easier.
For who?
I think for the Fed to do what they want to do without all the pressure of people screaming, like, stop the stimulus already, and I'm one of those people, because inflation is following all of this economic growth.
I'm confused. Doesn't this make it easier for them to taper?
Good? Yeah, but they obviously, for some reason, they want to do this on their timeline, and they don't want to be pushed into it. So, I'm not saying that they're going to make the wrong decision. I'm just saying nobody who has a voice in the stock market believes that they'll make the right decision on the timing.
Ben Carlson does.
What does Ben say?
You know, Ben believes in the Fed. He believes in the full.
He's a Fed believer.
Oh yeah.
Quote: COVID-19 cases are likely to continue falling, according to projections from CDC. If they do, households could tap into a record $142 trillion in net worth and ramp up spending on in-person services. Economists say consumer spending is the biggest driver of U.S. economic growth.
All of this, that whole sentence was nonsense. Was complete bunk.
What do we do with it's not going to be $142 trillion in net worth spent on anything.
Right. It's just economists say that people will spend money if the economy opens. Yeah, no shit. Right. Anyway, what are we saying here? What are we saying?
$142 trillion sounds like a lot of money. Is it a lot? It's like a lot. That's like a lot of money for household net worth.
Yeah, it's a lot. So hold on, but this is the good point, right? Like I saw multiple things, and I've seen this in some of our data. You know, like you can't go out and spend money. You're going to sit at home. Maybe you get a little bit more takeout, but like everybody's balance sheets at a like household perspective, not everybody's, a lot of people's balance sheets, they're super healthy. They just couldn't spend money.
They're the best ever.
Yeah. So like, yes, they're going to want to undo that. They're going to go out and splurge. We're going to see some really high vacation spending, all that sort of stuff, which is good because the service economy needs to get back into it. But that's just, you know, like money going from A to B, a little bit redistributionist in a good way. But we're also going to see the balance sheets get worse, right?
Why would the balance sheets get worse? Because people just start spending it down.
Yeah.
Okay.
Yeah.
But worse, but the economy's better? Like, isn't that kind of what we want?
Yes.
Okay.
Less inequality.
And if the money is moving around in the economy more quickly, that velocity of money, then the balance sheets matter less. What matters more is that GDP is still growing. Right? Like, I mean, from my perspective.
I mean, we've been in an incredible, I don't know how to put it, like ramp in asset values, both because of monetary policy and because people are just like saving money. They're getting stimulus checks. They get the stimulus checks. They put it into the stock market.
I think the only way GDP ever grows again above 2.5–3% is if the country, if the people who have been left out get involved. Because all of the asset values that have inflated or been, you know, that are going higher, that money's not getting spent. If you're a billionaire, how much money? There's a limit to how much money you could spend. So the rest of the country that is now being paid $18 an hour, they can get the economy going.
Well, so listen to these. I mean, to me, this sounds crazy. Federal Reserve reported Thursday the net worth of U.S. households was $134 trillion in the second quarter, up from $128.4 trillion in the first quarter. That figure stood at $110 trillion in the fourth quarter of 2019. So percentage-wise, it's like a very big jump, and the total household picture seems to be way better.
Home values.
I was going to say stock market real estate.
Home values are up 20%. Stock market's up 100%.
And I would put money on that the house values affects more people than the stock market.
Affects people's behavior or affects people's numbers?
Their balance sheets, both because more people are likely to just like go out and buy the houses. It's going to ramp up how much they're worth, and it's the cheapest form of leverage. Like leverage in your house is way cheaper than leverage in the stock market.
Okay, but cash is up too. A
What do you mean?
humongous amount.
Yeah.
Take stocks out, take real estate out. The amount of cash and cash equivalents on household balance sheets rose to $16.5 trillion in Q2. That's up from $12.7 trillion pre-pandemic.
That's stimulus, right?
Is that a 40% increase? I'm not great at math.
That's scary to me because, like,
What
if
the
you're
hell
just
is
holding
that?
money in cash, you're losing about 1.8% a year to inflation, right?
Yes.
Like that's just a straight 1.7% loss, almost certain.
Okay.
That's scary.
So what do you do with if you have 40% more cash now than you had in 2019? What do you do with it besides play with tokens on the internet? Like, what else can you really do? How much can you actually spend? Like, if you're not going to change your house, I guess, which would be the biggest purchase you would make, and we know a lot of people did. That to me is the most interesting thing, and that I think goes a long way to explaining why there's no yield for anybody. Because there's just too much need and desire for
too much money. Too much money chasing too few returns.
How does this reverse? It's not going to be permanent. We're not going to sit with cash balances that large in households forever. So what's the thing that changes that? No clue, right?
No idea.
What do you think?
There was a story recently about Zillow. They sold $450 million in bonds for stocks that they bought but haven't sold yet. I'm sorry, houses that they've bought but haven't sold yet. It was way oversubscribed. They're selling another $700 million worth of debt. People are so starved for yield. So I think the interest rates are not just low because of the Fed keeping overnight rates where they are, although that obviously has a huge effect on it. But there is so much money, maybe that's coming from the Fed. There's so much money that the overwhelming demand, there's not enough bonds. There's too much money, not enough bonds.
Wait, Zillow is selling bonds to back the value of all that real estate they bought, because now they're just buying your house at the click of a button, right?
iBuying is.
They're flipping now. They're flipping now.
All right, so in August, Zillow raised $450 million from a bond backed by homes it's bought but not yet sold.
It's like a securitized loan.
The offering, led by Credit Suisse, was modeled on the loan facilities that car dealerships use to finance floor models. We spoke about this last week, I think. Coinbase raised money at 4% for 10 years.
Yeah.
right? If you can't raise money now.
As a corporate.
What did Royal Caribbean raise money at? 11?
Yeah, if you can't raise money now, there's something seriously wrong with
So
you.
this, I think this is going to be a story that stays with us for the rest of our investing careers. I
You
mean,
don't-
that's,
you can't
forever is a long time, but
Is it going to unravel though? Like how does I know how 2008 unraveled, right? There was leverage in the house market, like that came down, but there's not a lot of
There were the defaults. The defaults in 2008 were the thing that caused the unraveling. All of a sudden, people thought they had like a certain yield coming to them on a certain instrument that was valued somewhere. And eventually, the values were all lies. And then when people actually started to sell, you saw what the real values were, which kicked off a panic.
But so where are the cockroaches today? And there are no defaults. I know that could change. I know that could change. Like we can have a recession that could all unwind. But right now, even below investment grade companies there's no defaults anywhere. Like companies' balance sheets are as healthy as the consumer.
Yeah.
Something will end this, right? Something always comes along and knocks the economy into a recession. Maybe stocks fall and take us into a recession, as Josh was talking about last week. But I don't know where it's coming from.
It would be ironic if the full reopening of the economy caused people to drain money from their stock market accounts to use, like to actually do things in the real world, and that was the thing that triggered a lot more selling. Like I think the stock market's going to be the cause of the next recession, but
There's two key numbers for me on the flip side of it in terms of cash interest rates, 1% and 2%.
okay.
So cash, like even if people hold cash accounts aren't really interesting at 1%, but like people are like, fine, I'll do that, whatever. At 2%, if we see cash interest rates at 2%, people are going to flee the stock market because they're like, 2% is fine.
Yeah, maybe.
2% is fine. I just don't want more.
2 is the walk away number for a lot of investors.
That's
It's
interesting.
inflation.
Yeah.
Right? Like if I can maintain the real value of it, I don't need gains. You go from 2% risk free to what? Like I thought I saw somebody yesterday was
45
saying
right
like
now. High yield is
6%.
45.
No, but what's
I'm
like
sorry.
U.S. equity, expected returns in U.S. equity?
4 to 6.
Exactly. So you get 4 to 6 with what? Like 12 to 15% vol, or 2% with 0%
with
vol.
no vol.
So I had money at Marcus at 2%. I was very happy to have money at Marcus. It's all gone. I'm not leaving my money at 30 basis points.
So the
whatever it
Fed
is.
thing is right. The Fed's the thing that like could decouple it quickly.
Wait, why aren't we talking about the fact that Mike fell for a teaser loan rate? Like more should be said about this subject.
No, it was
before we move on.
following Fed funds rates. They were at 2%.
Okay, so you were getting 2% from Marcus.
Jerome Powell, he rugged me.
He did rug you. You transferred money in, and then that just slowly got chopped, or one day they just chopped it.
No, it happens in increments, but it just kept happening. And also, I was like, I can't. You're forcing my hand. Thank you, Jerome.
Yeah, but they have such a cool user interface.
I have to take risk now. I'm not leaving my money earning a negative return.
Exactly. So that's the Fed's job. It works good on the way down.
This is where
The way
Goldman
up is
screwed up.
tricky.
They should have been on the phone with him before he even could have that realization.
So Dan, you're right. Like I don't. Where is the level? There is a level where at some point people are like, all right, I'm back.
Yep.
But I think that there might be so much demand for paper that might put a cap on how high rates can get.
Could you imagine what would be going on in the economy for rates to get back to 2%? It would have to be the mother of all inflation scares and the Fed like emergency raising rates.
But I feel like rates
rates
are decoupled from the economy. I don't think the economy drives rates anymore.
But like, how would a bank be offering a 2% rate unless, like overnight, all of a sudden, Fed funds rates had to move up for some reason?
Well, they would only offer it if it was commensurate with Fed funds rates because they would then loan out at 5%, which they're not doing. So,
yeah. Listen, it's hard to picture always what would send this into reverse.
well, how about this?
But when you hear $142 trillion in net worth in U.S. households, it's hard to imagine the economy not at least being decent.
So that's what I was going to say.
For I think a
A
long
while.
time.
It's hard, and it's hard to get too bearish on the stock market if the economy is really doing well. Can stocks fall 20% when the economy is doing fine? Of course they can.
It has.
Yeah, of course they
Many
can.
times.
They can do it. There's no laws governing that. But can they fall 30-40%? Probably not with a really strong economy, unless stocks falling drags the economy down lower.
Or they could fall, but very quickly V and be right and be right back.
Yeah.
I wanted to ask you about what's going on the Betterment platform because you guys have. Do you have 700,000 client accounts?
Yep.
Okay. I was reading about you this week. We'll get to that in a minute. 700,000 client accounts is an amazing sample
Isn't that crazy?
to figure out a lot about investors' attitudes toward almost everything under the sun, just watching what they're doing. So I asked you, like, what's some of the stuff that you're seeing on the platform? given that we have volatility back in the market. VIX hit 20 something this week. What are you seeing going on?
Before Dan answers, let me just, sorry to cut you off or cut in. I am very bullish on Betterment customers. I am very bullish on behavioral not integrity, on behavior. Go ahead.
You know his answer to my question is not going to be our clients are acting like Muppets, obviously.
No, I expect him to tell us the data. What's the data say?
So I'm gonna probably have to fire myself because I have no like substantial work left to do in this area. So
Your work here is done?
we had March, April 2020, right? And that was the setup for the behavioral mistake, right? Scary. Global pandemic, like real reasons to freak out personally, lives at risk.
Yeah,
business
like
shutdown. Like I can't say that we sailed through it perfectly, but like we would get an A if not an A+. Clients either just straight up stayed the course or they actually deposited through that. In the case where people needed to take money out of emergency funds, we saw a lot of outflows specifically for that. And then we saw inflows when stimulus checks and everything came in for other people.
How many people went to 100% cash?
Very so all right. So if you take 1,000 Betterment clients, 6 of them did something during changed something of any form between March and April of 2020.
Applause.
6 out of 1,000?
Out of 1,000.
That's basically 0.
I'm not done.
I mean,
it gets better.
I'm not done.
those 6 people all went long. TQQQ.
3 of them would have decreased risk, meaning like lowered their allocation, or went to cash in some form. They might have even kept it on the platform, but like they went to cash in some way. 2 out of those went the opposite way. They went bullish. They either deposited, they increased their risk level, whatever.
Look at that. Not me, by the way.
And then 1 out of those 6 took money out in some fashion because they needed it. You're talking about like unexpectedly, like emergency fund, blah, blah, blah.
So home run.
6 out of 1,000, and only 3 out of 1,000 are the ones that I need to worry about.
994 out of 1,000 clients. Yeah, dude.
Right? That's awesome.
994 out of 1,000 clients. Just
Not
whatever
bad.
they were doing.
Not bad.
Dude, that's
kept it
amazing.
going.
That's amazing. Let me just ask one
And
thing.
many of these people are on autopilot contributing.
Yep.
Because our clients on your platform are like set up that way.
Yep.
So I mean that's that. So Michael and Ben have this argument every other week on animal spirits.
Yep.
It's still riveting. I don't mean to say it like it's redundant, but are investors getting smarter? And where do you fall on that? I think Ben is saying no. You're saying yes.
No, it's the opposite.
Ben is saying yes, they are, and you're like, for now.
I just think that, and I want to give people.
Dan is here to say you're wrong.
I want to give people the benefit of the doubt. No, but I'm bullish on Betterment. I'm bullish on Betterment customers. I just think that we would have seen different behavior had we not V-bottomed, had we made a lower high, had this lasted more than 30 days.
I agree with you.
Like the recovery, it was paralyzing. It happened too fast to react. Same thing with the recovery.
Shock. Yep.
So if this lasted 6 or 7 months, I think we would have seen a little bit different behavior. But I still think by and large, it would have been a magnificent behavior.
Can I say one thing to you though? We didn't really V fully. We had a huge bounce off the bottom from March 23rd into April, but I don't think we got back to those levels until like October, November. Am I right or wrong about that?
I think it was like August. But listen, I don't want to split. I don't want to split hairs.
Okay.
Because even on the way up, I was bearish on the way up. Like I definitely, even when we were 20% off the lows, I was like,
I remember you started a newsletter and everything.
I bought gold bars. But I think that it happened so quick. The fall and the recovery happened so quick.
It did, but to be clear, that's the dangerous scenario. So here's the thing that's hard about like the whole like market timing thing. If you sell out and then things are crappy for a while, actually you made a good decision. It's when you like sell out and then things rally back. That's when you like you crystallized your losses and you missed out on the gains. So that's where that's why I was saying like actually this was the worst case scenario and we sailed through it. In a scenario where it's like people freaked out and then it was crappy for 2 years.
They feel vindicated.
Yeah, fair enough.
So let me ask you this, because I've always thought, and maybe you have some data or anecdotes to confirm this, that if somebody sells on the way down, let's say they sell at $10, whatever the security is, they are not buying back in at a number higher than where they sold.
It's hard.
Like that is really hard.
So they sell out at 10, it goes to 9 and then 11.
So if it goes to 9, their worst fears are confirmed, right?
Yeah, and if it goes to 11, they're like, well, I'm doing something else.
And if they go to 11, they're like,
Yeah.
but I sold it at 10. I can't buy it back at 11.
Yeah.
Because they're anchoring.
They're anchored.
bias.
I think like that is one of the hardest things is to buy back higher than where you sold.
So I want to I think you touched on something which is really important, which is are investors getting smarter or whatever? And the answer is no. They're humans, right? Like
So that's my.
we-
That's my.
we've
That's
not-
my. That's
Oh,
my,
it was, and it was never about intelligence. It's about emotion.
well, hold on. It's about churches and casinos.
Okay.
What we have done in financial services is that now there are a lot more churches that you can go to with your family on Sunday.
like Betterment.
Like Betterment, like you guys, like Vanguard was like in my mind like the first church, right? It's like
Yeah.
boring is sexy.
Oh, dude.
Low cost is cool.
It's a cathedral
you know?
to rational, emotionless investing.
So there's still casinos out there. There's still stuff that, and the same person will go to church on Sunday and they were like at the casino on Saturday night. They'll have their brokerage, their Robinhood
do
accounts,
that.
whatever,
Yeah.
right? But like at the same time, the church is there. They're going in, they're doing like the smart, responsible thing. They're like, yeah, retirement's important. My kid's college education is important. I got a line on those and I'm going to have some fun on the side too. But like the churches are there. And so like, that's why they seem smarter.
I love that. I love that analogy. Now, what about the church on the strip in Vegas that marries drunk people at 2 a.m?
There are some bingo games in some churches that just like the stakes are serious.
Yeah. Okay, so by that way of thinking, when we talk about investors monolithically, as though investors are doing this, investors are doing that, you could have a very rational, calm investor who also basically says, with 10% of my money, I'm on Robinhood. With 90% of my money, I'm in my 401k, and I'm at Fidelity.
I am.
And that's like,
a lot of people like
how
that.
does a behavioral person look at that?
It's like Bogle on the streets.
Yeah.
I don't know how to finish
Batnick
that.
in the sheets.
Bogle on the streets, Batnick in the sheets. I'm gonna vom.
That's like my whole thing.
Dude, this man is spinning and is great. Let's not even. How does a behavioral person then look at that? Because I feel like a lot of the models that people create, or a lot of people's worldview, is shaped on this idea that everybody is one or the other, or on that spectrum, but more toward one side.
Yep.
What if there's this what am I trying to say? What if there's like multiple versions of the same person?
Yeah.
You can't really model that.
Yeah, no, we're all like, we're different people in different contexts.
Yes.
You know, like, and one of the things, and this is the thing, we now can build the tools that we use to invest. We can build the things that we're like, how should I think about this? And like, am I building a thing that reflects the best me, the me that I want to be? So it's like, is it goal-based? You know, does it look at a portfolio rather than an individual security level? And I think that's the breakdown is like people are going to want to go to the casinos for the excitement and everything, but they also know that like actually most of their lives are going to be done on the like more serious, more boring, but like also like they're happy that it's taken care of well.
Is there somebody inside of Betterment at all the board meetings and stuff who's like, you know, we could kind of like build a little casino on the side?
Always. Yeah.
Right, because it's great for attracting new users and let them blow themselves up and be like, hey, you look like you can use some help, fella. Like with an email blast, like you're down 25% a month trading options for free.
Yep.
But maybe we could pull the rest of that cash over before you blow the rest of that shit up. Like, wouldn't that be a great CAC, a customer acquisition project?
Here's what I want to do. I want to build like the good Robinhood. Like
it exists. It's called Public.
No, that's just like while watching your friends, right?
You know Public?
I've seen TikTok ads.
They're trying to be like the angelic Robinhood.
They don't do payment for order
Free
flow.
trading, but no list of hot stocks, no
do they
prompts
make money
to get.
then?
They don't.
That's the problem.
They don't. Literally, their business model is tips.
So I want a brokerage that I'm going to set up, which is going to be like I only make money when you sell at a gain. That's how I make. I take like I don't know like.
Sounds like a hedge fund to
20
me, Dan.
bips, 25 bips when you make a gain. So I'm going to want people to like hold for longer because like stuff goes up on average.
Yeah, what's the carry?
I don't even know.
30%.
I was going to say like
how much of their gain do you want?
half of what would it be? 50 bips of any gain.
People don't know how much. When you say my work's done here, people listening to this, most people listening to this, have no idea, like how much work you've actually done.
Well, let me set that
on
up
the user interface side.
So let me help.
Please.
Let me help with an alley-oop. So one of the reasons why I think investor behavior has gotten better, even though we haven't gotten more emotionally intelligent, is because of some of the work that people like you have done.
It's too kind.
No, it's the truth.
No, it's true.
So if people went to sell, how many thousands of Betterment customers probably went to go from 80-20 down to 70-30? And you said, well, actually, If you do that, you're going to pay $14,000 in capital gains. Are you sure you want to do this?
And to be clear, Dan is not calling the person up, old school, like Wolf of Wall Street, and talking them out of trades. This is built into your technology.
So the technology, the nudges have made us better investors. Maybe I'll buy that. I do definitely buy that.
Yeah. I mean, like, and to be fair,
now compliment yourself. Tell everybody what you've done.
And what else? No red, green on the screen.
Yep. The IRS helps with it because like it's not like we're charging you for selling out right now. It's the IRS. They want those cap gains.
Okay, so let's explain this. So I have my money at Betterment. The COVID shit hits. Tom Hanks. Oh my God. I go to sell. Something pops up on my screen when I'm in your site and says, "Are you sure you want to do this? You'll be generating a capital gain of $7,000." And then give us the stat. How many people see that prompt and say, f it, I'm not going to sell?
So if you do exactly that, so one of the key things that was important to us is like market timing is different than like I need the money to go pay rent. So first thing, we're going to split it out by withdrawals versus allocation changes. So if you go in to do that allocation change, oh shit, I'm going from 100. Am I allowed to curse on this show? Okay. I'm going from 100% stocks to 0%
We're not really going to use any of this
stocks.
anyway, so don't worry about it. Go ahead.
This is the rehearsal.
Yeah.
You go from 100% stocks to 0% stocks. If you do that and you see a tax burden of, I think it's like more than $50, the odds that you're going to go through with that is like 6%.
Oh my
94% of the time, people are like, no, thank you.
I mean,
now,
this is it. This is holy grail shit.
Two more things happen, right? So part of that's like I try and encourage us to flash up the fact that it's short term, right? Like I just want you to be long term. Just don't pay short term cap gains. So in that case, it's still like like 6%. You change it over to say this is all long term, and it goes up a little bit. I think it goes up to like 90%, 85% don't go through with it, or so like 6 to 15% go through it. People will keep playing this game where instead of going from 100% stocks to 0% stocks, they go from 100 to 50. And they're like, crap, now it's like $2,000. That's better. Okay. They go from 100 and they say, like, what about 80?
You're showing them the results based on that toggling.
We can calculate it ahead of time. This is a preview.
But that's so much better. I'm fine with somebody going from 80-20. Oh,
yes.
If I overestimate my risk tolerance,
big deal.
I go from 80-20 to 60-40. That's fine.
Yep.
But to go from 80-20 to 0-100, that's not good. So I've had a long-standing beef with behavioral finance because quoting Kahneman doesn't help anybody. Nope. Right? It's always just like, oh, you're dumb. Not you're dumb, but you can't behave. You can't control yourself. Whatever, we all know that.
You're an ape, you're a lizard.
Yeah, we know that. But having solutions is like, that's what I'm there for.
Yep.
You're doing more, right? You're doing more than theory. You're actually putting the nudges into the system and then calculating how much aggravation and pain you're saving people when they're about to act. And you're intervening. Now, what's funny
I just want to be absolutely clear. Like, I am not paying them. They're just saying this of their own free will.
No, but I want people
There's
to.
no
we're
gun
fans.
under the table.
First of all, we're clients of. I guess we're clients or partners. I don't know what the legal is, but we have Liftoff, which we built, and it's on the Betterment platform. So you're doing that for our Liftoff clients too,
and for my kids.
And right, I have my own money on it. I just think honestly, I'm not saying like they should hand you an economics prize. However, they are giving prizes out to people who are writing books about this, and you're literally like building it. And I don't feel like you've gotten your flowers to the extent that you should. So hopefully, a lot of very influential people listen to this podcast. Hopefully that'll change.
One of the people who worked
and
at
you're not
Betterment,
alone. There's a whole
there's a
whole troop of people working on this like you are.
It's one of the nice things is that internally we have like customer feedback things, like one of the other things we have is this investing journal. You go to do a transaction, you can write down like what, like, sorry, I forgot my wife's birthday, got to take the money out, blah, blah, blah. And every once in a while, somebody will send me just like one that they wrote in where it's like, oh, thank God I saved up enough, like, I'm taking my wife out for her 10-year anniversary, whatever it is. So people send me these, and like I am like Scrooge McDuck in the gold coins when you get those things because you're like, we fucking did it.
Yeah,
like we built
all
something
the
that
stuff
is making
we said
people
we were going to do. We did. So now what's funny is you're popping that thing up. Like, are you sure you want to sell? When you go through like that thing on Robinhood, it's like I might want to change my allocation. They're like, "Have you seen crypto?"
Yeah.
They can't wait for you to make that sale. They have plans for you. They're like, "Why sell it when you could short it?"
Yeah.
Here's how much you could potentially make if So I just think it's nice that there's somebody working on high tech stuff for the market and not pretending that they're about democratization of finance, but like literally trying to make the end investors' results better.
What's nice about it too, I have no idea if people work at Robinhood, but like I love being able to go and like, yeah, you should use this. Like it's good, it's safe, it's responsible, it looks nice.
No, just listen. Robinhood's in a different business than you. That's the church versus casino thing writ large. Let's talk about bubbles because I feel like there's once again just a new like outcropping of people screaming bubble. It makes sense to me. There is a lot of bubble-ish behavior. I find that not all of it is in the stock market this time, which we can get into. This is Jeremy Grantham, who, Michael, is this his 15th bubble call in 12 years, would you say?
2010, have cash, wait for stocks to fall. I mean, he's been consistent, so.
Yeah.
All right.
Those are some headlines.
What do we got?
Listen,
this is great. 2011, Grantham sees most global equities as ranging from unattractive to very unattractive, valuing the S&P at no more than 950. Where is it now?
4,000
Good
something.
call. Grantham 2012 warns 2013 will be a dangerous year. 2013 was one of the best years for the stock market in history. 2014, big stock bubble and badly in 2016. Remarkable. He could see 2 years ahead. Actually, we rallied in 2016. 2015, GMO found that Grantham says markets ripe for major decline. So it's a martingale strategy.
Yeah,
What you're doing
double
is
down.
you double down, double down, double down. One day there will be a crash. This will end. And he's been calling for it since 2010. So we nailed it. I understand that the media wants to hear from him because he's one of the smartest people and he's an amazing interview. And I've listened to like probably 15 podcasts of people interviewing him, and you really get a sense of like how thoughtful he is. It just unfortunately has not been applicable to anything for any investor in a long time.
A fair thing I think to say here, and I've heard a number of people say this one way or the other. Like I think Adam Butler said it recently. He was like, at some point they changed the rules of the game, and either I don't know if that's like it was like TARP or like monetary policy, but like is it fair? Is it fair to say that like they changed the rules of the game?
100%.
They did. So throw your out. So stop using the same playbook from before they did that.
You've seen the chart of growth stocks versus cyclical stocks over time, and it like they went like this. So the structure of the market is so different today. The entire playbook is different, and I forget who says this, but Ben likes this quote. It might be Ben Thompson, that there are people who are experts at an earlier version of the world, and that makes them so much worse because they know how the game used to play, but the rules are different. So Grantham is very, very thoughtful. He said this to Barron's in 2015, 2016, maybe. So he's very self-aware. He said, I consider myself a bubble historian and one who's eager to see one form and break. I have come to believe, however, very reluctantly, that we bubble historians have been a bit brainwashed by our own exposure in the last 30 years to 4 of the biggest bubbles ever. Japanese, tech, whatever. So he goes, for bubble historians eager to see pins used on bubbles and spoiled by the prevalence of bubbles in the last 30 years, it is tempting to see them too often. So kudos to him, but he said that 5 years ago, and he's still doing it.
This is what he said this week. Grantham said U.S. stocks are in a magnificent bubble, which is crazier than 1929. Who talks like that? But he said the market is like a vampire that is hard to kill and will just shrug off bad news. He said
that's sour grapes.
He said meme stocks, SPACs, and cryptocurrencies were a sign of market craziness. Okay, I agree, but those have we've seen blow-offs in all of those things.
But Apple, like the greatest company of all time, is trading at like 23, 24 times earnings. There's bubbles all over the place, but the overall stock market.
No, wait, it's better than that. Wait. And then he goes, I swear this is true. This has been, he said this, who did he say this to? Who cares? CNBC. This has been crazier by a substantial margin than 1929 and 2000, in my opinion. Grantham said he thinks the S&P 500 is likely to decline 10%.
Shut up, 10%.
So just for context, 1929, the sell-off was 90%.
Yeah. Yep.
2000, the NASDAQ went down 95%.
Did it? Was it that big in 2000?
It was that, I think so. It was 89, 90, 95, something like that.
Tech stocks fell 80%.
Tech stocks.
Yeah.
Okay, yeah.
Berkshire Hathaway didn't.
The NASDAQ fell 80%.
Yep.
Like the dot-coms did. But just this idea of evoking 29, 2000, he missed 87 in here. I find that to be like disrespectful to the regular audience who has no clue the context that Michael just shared, doesn't know who this guy is, but just says, wow, that's the smartest guy I've ever heard speak in my life.
How about?
And he's saying it's 1929.
Earnings are at an all-time high, so that there's that. Now, can we be trading at an expected multiple to earnings? Sure, but like the Facebooks of the world these sort of companies change the rules of the game. If you could get to $1 billion in revenue, and I'm making that number up with 11 employees, like that is fundamentally different. And that is the structure of the market that we're in right now, where it's 25% of the market are these magnificent companies that have no precedence in history. Then the 1970s, 1980s, there was good companies, but not like this. That were just money minting machines.
Or are we wrong? Like, are we overstating how great today's companies are, and are we understating the possibility of mean reversion to earlier earnings valuations?
No, because nobody's saying that. I never say that markets can't mean revert to, but he's been saying his bearish thesis, and I hate to be so sound disrespectful because I do respect the man.
Dude,
but
this guy's gonna kill you.
His bearish thesis has been like operating margins mean reverting. Yeah. He said that was like one of the most powerful metrics of mean reversion in the market was operating margins, and they haven't because the makeup of the stock market
margins are expanding.
The makeup of these companies is so different than what he grew up with.
What do you do? What do you do? Like, what do you do with this? I know you don't pay attention to it, but like, what do you do with this conundrum that, based on everything we knew up until 1990, things worked a certain way, and for the last 30 years they just haven't? And you have so many people waiting for them to go back to that old paradigm.
So, I mean, that's progress, right?
Yes.
That's hot. Like, do you remember what infant mortality was 100 years ago?
Yeah.
100 years ago.
Yeah, are we going to mean revert back to that?
Like, I hope not, right? Like, that's progress.
So companies are better at being companies now.
And how about companies being able to lose hundreds of millions of dollars a year with unlimited funding until they scaled up to 1 billion users? That's a big part of our market right now, whether it's Uber or Tesla.
Well, that's the part where the rules have changed.
So, because the Fed, I'm not pointing fingers, because we have cheap money, that has fundamentally changed the playing field. Now, it doesn't have to be this way forever, but to not acknowledge that the market today is different than the market was 30, 40 years ago, it's like, come on, what are we doing here? You have to evolve a little bit.
Yep. The Fed inflation expectations purely on its own. Like, the Fed actually is good as its job, it seems like. Like, we haven't seen 8% plus inflation. Like, that's different. The other thing that I don't know about, although I'm curious about it, is the whole like public versus private market thing. Right, like
it's blurry now.
Yeah,
it's the same thing.
Like, I mean, like we're one of them now. Like, what $1 billion company?
Everyone's a unicorn.
Public? Yeah.
Okay. So they termed unicorn what 4 or 5 years ago.
That was Fortune in 2015.
So that was special.
Was the unicorn cover.
$1 billion private company. Every private company. Private company is $1 billion.
There were 40 companies that had private market valuations north of $1 billion. Now there's probably 1,000. You guys raised money at a $1.3 billion valuation, which, by the way, like, where's my soundboard? I think I lost it. That's pretty impressive. And when were you founded? 10 years ago?
So it was founded in 2010. I joined in 2013.
That's when the real growth
hockey
started.
Stick started.
Yeah.
Yep. The thing that's in my mind that I'm very proud of, is that the last valuation when we raised, it was like 800 million. And I don't know how long ago it was. And I am not like actually a financial person, so please tell me if I'm doing this wrong. We raised $60 million in equity this time at a 1.3 billion
By the way,
valuation.
We never got a phone call. I don't know if you meant to.
I didn't get a phone call.
Did you call the home phone, not the office? Okay. Go on.
And like, so if that's a $500 million valuation change with only $60 million of new money flowing in,
right?
$440 million of value growth over that time. Like, that's pretty cool.
Not
like,
nothing.
You're making something. You're growing.
It's not nothing. Right. Okay. So you're $32 billion in assets, and I was happy to read that the thing that everyone seems to be the most bullish on is the B2B business,
100%,
which is us.
Yep.
Let me just before we transition, just one list that I just want to throw in here. There was 45 unicorns in 2014 when this whole thing began.
45.
There's 800 today.
Yeah.
Well, listen, I look at the behavioral thing that we were just talking about as one of the changes of the rules of the game.
How so?
I wrote a post about this that I frequently reference because I still think it answers a lot of the riddle about why we have V-shaped recoveries and why we have such strength in disparate sectors when the market's trending. Yeah, look, if you have
the permanent bid, that was a good one.
Well,
yeah.
If you think about who's managing money now and how they're doing it, they're allocating.
Oh, the relentless bid. I'm sorry.
The relentless bid when the market when it won't be permanent.
That was 2014.
Yeah, dude. So if we're saying that investors are getting smarter, let's throw that out. Let's say advisors are getting strategically smarter about allocating.
More effective.
It's not brokers who are using volatility to trade more. It's advisors who are using volatility to take money out of treasuries and stuff it into stocks as soon as they can.
Yeah.
Everybody's dealing with the same puzzle. We have clients in their 60s who might live to 100, and bonds are not yielding enough to get them there.
That's another way that the game has changed. You used to be able to do that with a 50-50 portfolio.
Yep.
We cannot do that. We can't do it.
So why are we still surprised that every correction is met with a V-shaped bottom when we know financial advisors and sites like Betterment and firms like Vanguard, they are going to V that bottom every chance they get because they just have that much more money to put
By the way,
stocks.
in 2014 when you wrote this, like this was a brilliant piece, but there was definitely people like sounds toppy.
Yeah,
Absolutely.
I hope they faded me. How'd life work out? I remember getting a lot of people were angry about that. Oh, so you're saying the market will never go down? I should have said yes. That's what I'm saying. I would have been right. But you're 100% right.